It's a firm start for most European markets. While the CAC is a little soft, down by about 0.2%, the DAX and the FTSE have had a very good start. Both these counters currently holding up by about 1 to about 1.5% apiece. In fact, talking about Europe, let's also get you some more perspective. Joining us right now is David Buick from BGC Partners. David, hi, afternoon. If my voice is reaching you, it's been a good start. What is the market pricing in terms of the, big Merkel as well as Sarkozy meet? Any crucial outcome that we can expect?
I don't think so. I think they haven't really had enough time, and particularly since we know we've got another meeting, I think it's in March, to decide exactly how the refinancing of Europe is going to actually take place and whether they manage to get all the legalities from the various constituent companies tied up since then. But what I think we'll be looking for is some progress. Clearly we've had a relief rally today and yesterday because obviously some of the economic data, particularly for manufacturing, wasn't as awful as we thought it might be in Germany and France yesterday. And this morning obviously we're very encouraged by good data from India and good data from China. So it's given the market a little bit of impetus. Obviously, energy stocks have done extremely well this morning. And some of the banking stocks have had really reasonable updates, particularly Barclays, which is currently up just under 4%. But I think this is the sort of thing that you very often expect at the beginning of a financial year, particularly when you've had an extremely disappointing performance in the previous year. And we must remember also that some of the pension contributions that are made by many of the pension companies, they have to put money into the stock market in Europe. And obviously when volumes are as thin as they are at the moment, it's not surprising that if it gets some additional money put into it, it does tend to rally at probably at an exaggerated rate.
Right. David, there have also been reports that Germany may write down 75% of Greek government bonds held by private creditors. How do you think are European markets reading this piece of news?
It's very hard to try and write the script for the European politicians who, when I've spoken to you in the past, in the previous 6 weeks, have frustrated me enormously with what I describe as a rather moribund behaviour. It's very easy for me as a commentator sitting on the side to be very critical because obviously it's an extremely complex issue and getting it wrong is unthinkable because it would cost an absolute fortune. But I do believe what we haven't seen in the last 18 months is any powerful leadership in a concise and concerted manner. And I think most people are of the opinion now that Greece won't make the cut, that they don't have the broad-based economy to be able to rally to the cause, impose huge austerity cuts and grow their economy. It's just not plausible, it can't be done, and I think the quicker that we realise this, and if the European Union were to serve notice, whether it's 3 to 5 years, to take Greece out of the Eurozone but remain in the Euro area, I think this would have a very positive effect on the market. Yes, of course it would mean losses would be incurred, but they've already been incurred by the banks who've taken at least a 50% haircut in many of their bond holdings. But what we haven't seen is this leadership, and I think even though you may consider my thoughts rather draconian, I think it would have a positive effect on the marketplace.